doing a massive amount of reading. I don't think there's any one book that will do it for you.
Yeah. You might think about picking out 5 or 10 companies where you feel quite familiar with their products, maybe, but not necessarily so familiar with their financials and all of that. But pick out something so at least you understand if you understand their products, you know what's going on in the business itself, and then get lots of annual reports and through the internet or something else, get all the magazine articles that have been written on those companies for 5 or 10 years. Just sort of immerse yourself as if you were either going to work for the company or they'd hired you as the CEO or you were going to buy the whole business. I mean, you can look at it in any of those ways. And when you get all through, ask yourself, what do I not know that I need to know? And back many years ago, I would go around and I would talk to competitors always. You talk to employees of the company and ask those kind of questions. That's in effect what I did with my friend Lorimer Davidson when I first met him at GEICO, except I started from ground zero. But I just kept asking him questions, and that's what it really is. One of the questions I would ask if I were interested in the ABC company, I would go to the XYZ company and try and learn a lot about it. Now there's spin on what you get, but you learn to discern it. Essentially, you're being a reporter. I mean, it's very much like journalism. And if you ask enough questions, Andy Grove has in his book, he talks about the silver bullet. You talk to the competitor and you say, if you had a silver bullet and you could only put it through the head of one of your competitors, which one would it be and why? Well, you'll learn a lot if you ask questions like that over time. And you ask somebody in the XYZ industry and you say, if you're going to go away for 10 years and you had to put all of your money into one of your competitors, the stock of one of your competitors, not your own, which one would it be and why? Just keep asking and asking and asking. And you'll have to discount the answers you get in certain ways, but you will be getting things poured into your head that then you can use to reformulate and do your own thinking about why you evaluate this business at this or that. The accounting, you just sort of have to labor your way through that. You may be able to take some courses even in that. But the biggest thing is to find out how businesses operate. And
I would like to know the accounting book you like best. Thank you.
Well, it's been a long time since I've read an accounting book. I read Finney back when I was in college. I remember that. And I always liked accounting. And for any of you interested in business, you basically can't get enough accounting. But I don't, I'm not really up to date on accounting books. Maybe Charlie's been reading some of those lately. I would hope, actually, that if you read the Berkshire reports over time, that you get certain, perhaps, lessons on accounting. But I think you learn more accounting probably in terms of, once you know the basics of it, by reading good business articles that deal with accounting issues, accounting scandals, that sort of thing. That's what you really need to know. Is you need to know how the figures are put together, the underlying principles of it, and then you have to know what can be done with those. And you start with the accounting figures as the raw material of understanding a business, but you have to bring something additional to that. And I can't think of any good books on that subject. I think I've read a lot of good magazine articles that contributed to my knowledge over the years. And I've read a lot of annual reports and seen what people can do with accounting. And as I've said before, if I don't understand it, I figure it's probably because the management doesn't want me to understand it. And if the management doesn't want me to understand it, there's probably something wrong going on. People don't obfuscate with numbers, usually without a purpose. And when you run into that, the best thing to do is just stay away. Charlie?
Yeah, asking Warren, what good books he knows about accounting would be, it's like asking him what good books does he have about breathing. And what the implication of that is that you start by learning the basic rules of bookkeeping, which are sort of like the basic rules of addition and subtraction. And then you have to spend a lot of time before that accounting gets related to the larger reality. And that's a lifelong process.
Pay a lot of attention to what we regard as the reality of the balance sheets and economic condition and cash situation, all of that of a business. And sometimes we think accounting reflects reality and sometimes we don't. It's a good starting point for us always. But I mean, there are companies in the there's at least one company, at least last year, that was using a 12% investment return assumption on its pension plan. And there are other companies that use, I think, even below 6, certainly 6. And in the end, should we look at the figures the same of one company, particularly if the pension fund's a big element, that uses 12 and 6? No, we look at what it says they're using, but in our minds, we don't think the company that's using a 12% assumption is likely to do any better with their pension fund than the one that's using 6. In fact, we might even think the one that's using 6 is likely to do better because we might think they're more realistic about the world. So we start with the figures of the companies we look at, but we've got our own model in mind as to what they will look like. It's true of the businesses we own 100% of. Some of them have some debt in them, some of them don't. Partly that situation's inherited. In the end, we've got the same metrics that apply to them, whether they happen to have some debt on their own particular balance sheet or not, because in the end, we're not going to be willing to have very much debt at all at Berkshire. And where it's placed doesn't really make any difference because we're going to pay everything we owe no matter where it is. And it's almost an accident whether Company A or Company B has a little debt attached to it.
I have a two-part question. First part very short. I think a lot of people have difficulty valuing businesses because of some convoluted accounting schemes that are out there. Do you have any suggestions in terms of books or something you can read where you can sort of make sense of some of the accounting stories that are going around?
Well, that's a good question. And Abe Breloff used to write for Barron's quite frequently on various accounting machinations, and Barron's has continued that somewhat. But you're right that there are people out there who will try to paint pictures with accounting that are something far from economic reality. And sometimes the rules of accounting themselves lead to that. I would say that when the accounting confuses you, I would just tend to forget about it as a company. I mean, it may well be intentional, and in any event, you don't want to go near it. We have never had any great investment results from companies whose accounting we regarded as suspect. I can't think of a one. Can you, Charlie?
No.
It's a very bad sign.
I made a short sale once that worked out well in a case like that.
No. It really, accounting can offer you a lot of insight into the character of management. And I would say there's a lot, you run into a fair amount of bad accounting. I used to call it creative accounting, which is, and you probably run into a lot more if it was allowed, but some companies have been able to push their auditors pretty far, and I would be very skeptical of anything that looks suspicious to you. I think there have been a couple of things written, but I can't think of where they've appeared, where people talk about the questions of, what, obviously if some prepaid expense, deferred asset accounts start building up suspiciously high, and inventories look out of line, with sales and particularly the trend of them and all that. You want to look twice at companies like that. Life insurance, frequently that, we see weak accounting in it. You can, when you don't have a product where revenues and expenses are being matched up on something close to cash in the short term, you have the opportunity for people playing games with numbers. And some people have learned how to do that very well, and they've sometimes created long-lasting stock manipulation or promotion schemes that have enriched themselves where they've enriched the managers or the
creators of it at the expense of the public over time. If you ever get suspicious about accounting, just go on to the next company.
You have been recently quoted in the newspapers as saying that some major corporations have used questionable practices to make their operations seem more favorable. Would you be willing to be more specific about these practices?
Not until I'm on my deathbed. I have followed a policy of criticizing by practice and praising by name, and we will not. We do. Charlie and I both find certain practices very, very deplorable, and they aren't limited to a single or a few large corporations. But we would probably be less effective in arguing for change if we went to a few specific examples. They would not be that much different probably than hundreds of other, or at least dozens of other companies, and secondly, those who get critical of the world find the world gets very critical of them promptly, and I think we do more good by, in a sense, hating the sin and loving the sinner. So we will continue to point out the sin, but we will not name the sinners. Charlie?
Warren, I think she wants you to name the practices,
Oh, the practice-
not the miscreants.
No. Well, the practices are some of the things we've said. They relate to accounting charges that are designed to throw into a given period a whole lot of things that should have been covered in subsequent periods in the earnings account, or to smooth out or to inflate earnings in future accounts. There's a lot of that being done. There's a lot of it's been done. The SEC under Arthur Levitt, who I admire enormously for his efforts on this, is making a concerted attempt to get corporate America to clean up its act on that. But it'll only be because somebody hits them over the head. I mean, it has become totally fashionable to play games with the timing of expenses and revenues, and frankly, until the SEC got tougher, in my view, the auditors were not doing enough about it. I think that in terms of hiding compensation expense and not recording it in the case of options and all of that, I think companies now have the option of recording option costs in the income account, but you have not seen any great flood of people doing it. And actually, the way they show it in the footnotes is quite deceptive in my view, because they try to make assumptions that minimize what the income account impact would be, but the cost to the shareholder is what counts. I mean, that is the compensation cost as far as we're concerned, and that's been minimized. The whole effort to engage in pooling rather than purchase accounting has seen a lot of there's been a lot of deceptive accounting in that respect. There's been deceptive accounting on purchase accounting adjustments. So those are the kind of things we're talking about. Charlie?
Yeah, it's the big bath accounting and the subsequent release back into earnings of taking an overly large bath that create a lot of the abuse.
We could name names, we won't. But, I mean, we have seen firsthand managements who think they are doing, they say they're doing what everybody else does. The truth is they are now, because everybody else is doing it. And it takes some outside force, in this case, probably the SEC, it should have been the auditors, to clean up the act. Because once it becomes prevalent, the fellow who says I'm going to do it fair and square, all of a sudden becomes at a disadvantage in capital markets. He's penalized, and he says, why should I penalize my shareholders by doing something when legally I can get away with doing something else?
Earlier in the meeting, you said, reading over financial statements, you identified companies you were virtually certain were frauds. What was it in those financial statements that you saw that made you be so certain they were frauds?
Well, it varies just enormously. There are, we can't identify 100% of the frauds, or 90% or 80%, but there's certain ones that jump out to you. Just people give themselves away a lot too. I mean, in poker they talk about tells, and Charlie and I have bought a lot of businesses, and it's very important when we buy those businesses that we assess the individuals that we're buying from with some degree of accuracy, because they hand us the stock certificate and we hand them a lot of money, and then we count on them to run the business with as much enthusiasm after they have the money as they did before. And so we are assessing people, and we don't think we can assess everything accurately. We just have to be right about the ones where we make a personal decision. And those decisions have not always been perfect, but they've been pretty good, and I would say they probably got a little bit better. Similarly, looking at financial statements, for example, in the insurance field, we've seen some frauds, and you can see things being done with loss reserves occasionally. We saw it back in many names on my Charlie. I don't call company A's and B's and naming names, but you would see companies that when they were offering stock to the company a year or two before that, they were down very suspiciously, or even when they were selling them to other insurance companies. If they were buying in stock, they might be building the reserve that. But there's a million different ways, and I don't claim I know all the ways, obviously, but I have seen enough situations over the years, and I've seen how promoters act, and you can spot certain people who are one way or another playing games with the numbers. They give themselves away, but I can't give you a checklist of 40 items or something of the sort that you look for in the balance sheet or the income account or the footnotes. Charlie, can you help him anymore?
Sometimes it's pretty obvious. I once was introduced by Warren of all people by accident to a man who wanted to sell us a fire insurance company. Among the first things he said with a thick accent, Eastern Europe,
Don't name countries.
and I don't remember the country.
Good.
But what he told me was, he says, it's like taking candy from babies, he said. We only write fire insurance on concrete structures that are underwater. Yeah. I figured out instantly that it was probably fraudulent. I'm a very acute man.
Now, were you had some experience as a lawyer in the movie industry?
Oh my God.
Yeah, when you get into accounting for, well, movies are a good thing, right? How fast you write off property, anything on the business. Got construction jobs, market payment type things. There's so many ways you can cheat in accounting. In financial institutions are particularly probably prone to it. And there's been plenty of it in insurance.
A lot of it, they're not being deliberately fraudulent because they're deluded. In other words, they believe what they're saying.
Yeah, people like to hire better salesmen. If you've got doubts, forget it. Probably somebody. It's interesting, the accounting, it worked harder and harder and harder coming up with disclosures in accounting. And I'm not sure I find present financial statements more useful, or in some cases as useful as I found them 30 or 40 years ago. Charlie?
Well, I think the financial statements of big banks are way harder to understand now than they used to be. They just do so many different things, and they've got so many footnotes, and there's so much gobbledygook. It doesn't. They're not my grandfather's banks.
Well, we couldn't understand them when we owned them. I mean, we bought a company that generally they had 23,000 derivative contracts. And Charlie and I could have spent 24 hours a day and had the help of 10 or 20 math PhDs, and we still wouldn't have known what was going on. And, it cost about $400 million to find out. And that was in a benign market. But nobody can.
And the accountants had certified the balance sheet.
Sure.
It's a new kind of asset I invented a name for. I said, good until reached.
An ally has been slain.
Well, and you would actually, the same auditing firm would be auditing two different companies on the opposite side of a derivative transaction and attesting the different values of the same contract. Charlie found one mistake on the derivative contract. What was it, 20 million?
But it was a big contract, and both sides reported a large profit blessed by their accountants on the same contract.
Kind of like us in
Just
Swiss
from
Re.
making it. The moment you get in a competitive frenzy, things just go out of control.
I became the interim chairman, interim CEO of Solomon
Shut down.
in 1991. And fortunately, I had testified to both the House and Senate committee before I found this out. And generally speaking, incidentally, Solomon wanted to have conservative accounting, fair statement, and in many cases did. But they did come in to me one day, and they said, Warren, you probably should know that we have this item, I think it was around 180 million or something like that, with a capital base of 4 billion maybe, but 180 million. And they said, this is a plug number, and we've been plugging it ever since Fibro merged with Solomon in 1981 for 10 years. This number moved around every day. And as I remember, Fibro or one of them was on a trade date system, that was on a settlement date system. And in 10 years with Arthur Anderson, as an accountant paying a lot of money in auditing fees, they just never figured out how the hell to get the thing to balance. So they just stuck a number in every day. And they literally plugged it for 10 years. I couldn't figure out how to plug it myself. I mean, they almost had to start over. Didn't they do that one time?
We did that.
Yeah, right.
We had a discrepancy when we changed accounting systems in our savings and loan, and none of the accountants could fix it. So we just let it run out.
It has been destroyed.
Yeah, we let the account.
We just let the account run out, and
We start over again.
We started over, right?
Yeah. Accounting is not quite the science that people might want to.
Accounting, you can do things like they do it in Italy when they have trouble with the mail, it piles up, irritates the postal employees. They just throw away a few carloads. Everything's flows smoothly thereafter.
Folks. So that happened in some unnamed international country.
Yeah, Italy.
I have a follow-up question to your comments about how financial statements can be distorted by making over-optimistic assumptions about returns for the pension portfolio. If you believe accounting statements, as published in annual reports, returns on equity for U.S. businesses are amazingly high, higher than in Europe, higher than they've been historically, higher than Japan. Are these highs, do you think, completely attributable to accounting shenanigans, or are there any fundamental reasons in addition that might make returns in the U.S. higher than in Europe or higher than they've been historically?
Well, I would say that they certainly, to the extent that American returns have been higher than those around the world, at least in developed countries, I would say that they are not solely due at all to accounting shenanigans. I think that the absence of honest accounting for option costs and has been a factor, but American business has done very well, excluding any accounting activities that Charlie and I might differ with. I'm no expert on exactly what returns have been around the world in developed countries, but my impression definitely is that American business is well above average for the developed world in terms of profitability, and I don't have the answers as to why that's occurred. I think that American business and I think the whole American system has reflected more of a meritocracy than exists in many countries, and I think that a meritocracy works best. I think that mobility between classes, which is the flip side of a meritocracy, does tend to get the Jack Welches into positions of where they run a General Electric or an Andy Grove or an Intel or Sam Walton at Walmart. I think if you'd taken those same individuals and dropped them down in most countries, they would have done very well, but I don't think they would have done quite as well as here. And I think that what they have done well has spilled over in a big way to benefit the American economy. So I would not lay it all on the accounting shenanigans. And the pension fund accounting, that applies very heavily at some companies, and of course most newer companies don't have pensions. Companies that have started in the last 20 or 30 years are much more inclined to have various kinds of profit sharing or 401ks. The older industries that took on pensions have spurred to a great degree, I think, by World War II, when you got excess profits taxes that ran to 90%, and there was a huge incentive to start pension plans and fund them heavily, because the government, in effect, was funding 90% of your pension obligations. So there was a great boom period in the inauguration of pension funds, and of course that meant steel and auto and all of those big industries at that time. Charlie?
Yeah, it isn't so much accounting shenanigans as it is deliberate financial practice. Take General Electric. There's been a deliberate increase in financial leverage, which was made possible by the wonderful and deserved reputation. There's been a deliberate increase in repurchase of stock, which General Electric has done even when they're paying huge multiples of book value. That sort of thing does wonders for returns on equity, as reported, as does the process of writing off everything in sight and various extraordinary charges, removing the burden of past costs from future earnings. You put all those things together, and American returns on equity are higher partly because the management is deliberately set out to paint the company as unusually efficient in its use of capital, meaning that it earns a high return on shareholders' equity. Think of how high we could drive our return on equity at Berkshire. I mean, we could make it almost any number you want if we just used enough leverage.
Yeah, we could run it with no equity.
We could run Berkshire with no equity. And then people could say, gosh, these guys have finally learned how to manage the damn thing. It's not been an objective around here to reduce the equity to zero. But at other places, in order to make the reported return on equity good, they deliberately pound down the net worth as much as they can.
Yeah. The questioner may have seen, if you look at the S&P figures of the last 15 years, they report them both before special charges and after special charges, and there's been a very significant difference between those two figures. I mean, the American business likes to frequently write off things and say that doesn't count. And of course that takes the equity down, and it actually frequently benefits future earnings because you remove costs that would otherwise hit the income statement in future years.
The truth of the matter is you have part of this is shrewd and correct management of the company's financial structure and operations. And part of it can drift into gamesmanship.
We don't like complicated accounting. I mean, we really do like things that produce cash, and Enron is a good example. Enron's grotesque in what happened, but there's no question in my mind that auditors have been unduly compliant to client wishes over the last few decades, and more so as they went along, even to the point where they started suggesting what I would consider quite dubious accounting to people in mergers and so on, so as to make their figures look better later on. And I've seen it firsthand. So I think that although the auditors are supposed to work for the shareholders, that they got too much so they were working for management. But I think that Enron may push them back significantly, even in the other direction. I think Enron will have a distinct beneficial effect on auditing, and it was needed.
So it's going to have a distinct beneficial effect on one fewer auditors.
Yeah, although, you know, it's an interesting question, and Charlie and I may differ on this. I mean, I don't know how many people Anderson employed, but it was a huge number. And it's clear that the weaknesses and culpability at Anderson goes far beyond anything remotely we saw at Solomon. But it would have been a shame for Solomon, with 8,000 people, to have actually the bad acts of one guy and the lapse in terms of reporting and all of that, which was a big mistake, but by a few other people, caused 8,000 people to get dislocated in their lives and lose their jobs. I don't know, how do you feel, Charlie, about, you know, the bottom 40,000 people at Anderson who really didn't have a damn thing to do with shredding or the Houston office or anything of the sort? I mean, their lives are really getting changed in many cases.
I regard it as very unfair and totally undeserved in all those cases. Yet even so, I think that capitalism without failure, somebody once said it's like religion without sin, or
religion without hell.
Religion without hell. I think when it gets this bad and the lack of adequate control mechanism throughout the system, I mean, Anderson plainly didn't have a good total system of control. And I think that it may be that capitalism should just accept this kind of unfairness in all these individual cases and let the firms go down.
Well, let's say you and I did something really terrible, Charlie, at Berkshire. How do you feel about the other 130,000 people then? I mean, should they?
You'd feel terrible about them. And there's no question about it. And but I'll tell you something, they wouldn't go down. The way we're organized, they wouldn't go down. Martin, there's nothing you can do that is going to destroy the value of the subsidiaries and the careers within the subsidiaries. You can blow your own reputation. You can blow the reputation at the holding company level, but you can't destroy their livelihood. That is a good way to be organized.
We could mess up their lives, though. I mean, if they lost their funding, or I mean, I agree with you about their viability, but you know.
Not very. Anderson was particularly vulnerable being a professional partnership, but maybe you should be extraordinarily careful if you're a professional partnership with what clients you take on and how far you go for them. The law firms that I admire most have fairly strict cultures of risk control. I think it's crazy in the kind of world we inhabit to operate in any other way.
The second involves the role of creative accounting and the stories of tremendous growth and success over many years. GE, Tyco, and IBM immediately come to mind for me.
He asked about creative accounting, and he named certain companies. I wouldn't agree that all those companies were plainly sinful, although I'm sure there are very significant sins in the group as a whole. Creative accounting is an absolute curse to a civilization. You can argue that one of the great inventions of man was double entry bookkeeping, where we could keep our economic affairs under better control. And it was a North Italian development spread by a monk. And anything that sort of undoes the monk's work by turning this great system into kind of a tool for fraud and folly, I think does enormous damage to the country. Now, I think a democracy is ordinarily set up, so it takes a big scandal to cause much reform. And there may be some favorable fallout from Enron, because that was certainly the most disgusting example of a business culture gone wrong that any of us has seen in a long time. And what was particularly interesting was it took in eventually a lot of nice people that you wouldn't have expected to sink into the whirlpool. And I think we'll always get Enron type behavior, but it may be moderated some in the next few years.
I was hoping you could also discuss that issue in relation to Coke. Some people have said that their decision to lay off much of the capital in the system onto the bottlers who earn low returns on capital is a form of creative accounting. On the flip side, others counter that Coke's valuation at first glance on, say, a price-to-book metric is actually less richly valued than it seems because they earn basically all the economic rents in the entire system.
Question of accounting and the economic profits to be gathered in the bottling system versus the production of the syrup at Coke. I've just gotten through reading the annual reports of Coca-Cola FEMSA and Penamco, which are two big Latin American bottlers, and I mean they make pretty decent money, quite significant money, and there is more money in owning the trademark. It isn't the plants that make the syrup or anything else. The trademark is where a huge amount of value is. The trademark is where a huge amount of value is in See's Candy. Those are big assets, and I would say that you can make good money as a bottler. A lot of bottlers have become rich over the years. If I had a choice between owning the trademark and owning a bottling business, I'd rather own the trademark. But that doesn't mean the bottling business is a bad business at all, and it's riding on the back of a trademark. I mean, that is why a bottling system is valuable, is because it has the right to sell a trademark product, which hundreds of millions of people every day are going to go in and ask for by name. And the right to distribute that product is worth good money. And I don't see any accounting questions in that sort of thing. In other words, if the Coca-Cola company did not own a share in any of its bottlers, and for many years it either owned 100% of a bottler, or large part, or and very few of those, or none of it. But if they own no interest in their bottlers, I think the economics would be very, very similar to what they are now. I mean, the bottlers would still be able to borrow a lot of money because they would have contracts with the Coca-Cola company and that were important and that would allow them to make decent money distributing the product, but they don't make the kind of money that you make if you own the trademark. Just the way it works.
Yeah, that accounting issue is of a type that is very common within Berkshire. We are so horrified by the terrible business decisions we see made all around us by people who are relying on over-optimistic accounting that we tend to almost reach for opportunities to make our accounting very conservative, way more than other people. We think it protects our business decision-making as well as our financial integrity. I don't know why we ever got into this business of trying to get the accounting result as close to the chalk as we could possibly get it. what is wrong with the world when everything is a little bit underreported? I mean,
Yeah, generally, people think that reporting is, and transparency and all that has improved over the years. I felt much better working with the financial statements in 1960 than I feel working with financial statements in 2000. And frankly, in many ways, I thought they taught me more about what the company was really about than the current ones do, even though there was far less detail. And what we really deplore is solving operating problems by accounting maneuvers. And, Gen Re had some problems in the mid-'80s when everybody did, and they went to discounting their workers' comp reserves. And it was a quick fix, but it's like heroin. And you get on it, and it's not easy to get off. And Charlie and I have seen that time and time again. People that think, trade loading, whatever it may have been, they think they're going to solve something by playing accounting games. And they're encouraged by their CFOs sometimes, and frequently they were encouraged by their big name auditors in one way or another to really play with the numbers, and it catches up with you. You might as well face reality immediately and take whatever operating steps are necessary to solve problems, or if you can't solve them, just give up on them. But whatever you do, playing with the numbers it never works. Although I guess if you're 64 and a half and you're going to retire at 65, it might get kind of tempting.
Mr. Buffett, in this year's shareholder letter, you have harsh words for the new accounting rule that requires companies to use market value accounting for their investment holdings. For analytical purposes, you said, Berkshire's bottom line will be useless. I'd like to argue with you about that. Shouldn't a company's earnings report say everything that happened to and within a company during an accounting period? Shouldn't the income statement be like an objectively written newspaper informing shareholders of what happened under the management for that period, showing what management did to increase shareholder value and how outside forces may have affected the firm? If securities increased in value, surely the company and the shareholders are better off. And surely they're worse off if securities decreased in value. Those changes are most certainly real. In my opinion, ignoring changes in the way that some companies ignore restructuring costs is censoring the shareholders' newspaper. So my question is, how would you answer what I say?
Well, my answer to the question and asked what my answer would be to what he said. I would ask Jack, we've got $170 billion of partly owned companies which we intend to own for decades and which we expect to become worth more money over time, and where we reflect the market value in our balance sheet. Does it make sense to every quarter mark those up and down through the income account when at the same time we own businesses that have become worth far more money in most cases, and become, since we bought, you name the company, take Geico, an extreme case, we bought half the company for $50 million roughly. Do we want to be marking that up every quarter to the value and having it run through the income account? That becomes an appraisal process. There's nothing wrong with doing that in terms of evaluation, but in terms of a value, and you can call it gain in net asset value or loss in net asset value. That's what a closed-end investment fund or an open-end investment fund would do. But to run that through an income account, if I looked at our 60 or 70 businesses or whatever number there might be, and every quarter we marked those to market, we would have obviously a great many, in certain cases where over time we'd have them at 10 times what we paid. But how quarter by quarter we should mark those up and run it through the income account, where 99% of investors probably look at net income as being meaningful in terms of what has been produced from operations during the year, I think would be, well, I can say it would be enormously deceptive. I mean, in the first quarter of this year, you saw the figures earlier where we had the best, what I would call operating earnings in our history. And our securities were down $6 billion or whatever it was, To keep running that through the income account every day, you would say that we might have made on Friday, we probably made $2.5 billion. Well, if you have investors and commentators and analysts and everybody else working off those net income numbers and trying to project earnings for quarters and earnings for future years to the penny, I think you're doing a great disservice by running those through the income account. I think it's fine to have marketable securities on the balance sheet. The information available is to their market value, but we have businesses there. If we never would do it, but if we were to sell half, we'll say, of the BNSF Railroad, we would receive more than we carry from. We could turn it into a marketable security, and it would look like we made a ton of money overnight. Or if we were to appraise it every 3 months and write it up and down. It could lead to all kinds of manipulation, but B, it would just lead to any investor being totally confused. I don't want to receive data in that manner, and therefore I don't want to send it out in that manner. So, Charlie?
Well, to me, it's obvious that the change in valuation should be noted, and it is and always has been. Goes right into the net worth figures. So the questioner doesn't understand his own profession. I'm not supposed to talk that way, but it slips out once in a while.
Sometimes he even gives it a push.
Pertaining to cash flow analysis, given the practices of the numerous corporations of deliberately fabricating cash flow numbers, which occurred in some of the telcos, where they characterize like-kind exchanges as product sales, how do you ferret out this type of fraud? What do you recommend a shareholder or an individual investor to do, short of obtaining a degree in forensic accounting, to uncover this type of fraud?
Yeah, I think you're asking for a lot if you want some simple way of not being taken in by the frauds of the world. If you stop to think about it, enormously talented people deliberately go into fraud, drift gradually into it because the culture carries them there. And the frauds get very sophisticated and they're very slickly done. I think it's part of the business of getting wisdom in life that you avoid getting taken by the frauds. And so I think you're asking a very good question, but I don't think there is any short answer. I think there are whole fields that you can just quit claim because it looks like there's too much fraud in it. And I think we do a lot of that, don't we, Warren?
Yeah. How many times have we been defrauded in the last 20 years, huh?
Well, damn little that we can. It's amazing how little. Yeah. And I've always said that the guy who takes us is going to have a modest little office and modest demeanor, and
he'll carry around Ben Franklin's autobiography. I can guarantee you.
The kind of people who defraud us are not going to be the kind of people who are defrauding everybody else.
Yeah, it's a very good question. It's tough to answer, but I will tell you that we haven't and we won't get defrauded often. Now, that means we pass up a whole lot of other opportunities, too. But, for example, you raised the question about cash flow. I would say the number of times we're going to buy into a company, whether it's through stocks or through the entire company, where people are talking about EBITDA, is going to be about zero. I mean, we start out with, if somebody's talking about EBITDA, if we take all the people in the world who have talked about EBITDA and all the people in the world who haven't talked about EBITDA, there are more frauds in the first group, percentage-wise, by a substantial margin. Very substantial. I mean, it is it's just a start. That doesn't, it's very interesting to me. If you look at some enormously successful companies, Walmart, General Electric, Microsoft, I don't think that term has ever appeared in their annual reports. I mean, they just So when people are talking about that sort of thing, either they're trying to con you in some way, or they con themselves to a great degree. I mean,
Or both.
yeah. Well, that often happens. I mean, if you set out to con somebody, after a while you con yourself, which is why some of the people in the internet stocks, stayed with them. It's if they think you're focusing on EBITDA, they may arrange things so that number looks bigger than it really is. It's bigger than it really is anyway. I mean, the implication of that number is that it has great meaning. You take telecoms, they're spending every dime that comes in. I mean, in many cases, and it isn't cash flow. I mean, the cash is flowing out, but you can look at the statement and there's billions of dollars supposedly in depreciation and so on, but interest is an expense. Actually, taxes are going to be expense. Anybody that tells you that making a lot of money before taxes, that in terms of EBITDA, is meaningful, you get depreciation by laying out money ahead of time. It's the worst kind of expense. We look for float, where we get the money and then pay out later on. But depreciation occurs because you buy an asset first and then you get the deduction later on. It's the worst kind of expense there is. And you start paying taxes when you actually make money and when the depreciation runs out at some point. So it just amazes me how widespread the usage of EBITDA has become, and I would say there have been people who have tried to dress up financial statements in a way to appeal to people who were impressed by such a number. Charlie and I have found actually that, at least to us, many of the crooks look like crooks. I mean, we have spotted, we haven't shorted them, but we have spotted a lot of frauds over the years in public companies, and years before that the roof fell in. And they usually are people that tell you things that are too good to be true, for one thing. I mean, they tell you very mediocre businesses are wonderful businesses for one reason or another, or they just have a smell about them, and in effect.
You have argued against the use of alternate measures of profitability, such as earnings before interest, tax, depreciation, and amortization, as measures of business performance. At the same time, you have frequently cited the incompleteness of generally accepted accounting in reflecting economic reality for some businesses, implying that there are some necessary and proper adjustments. Beyond what you recently described in the annual report as the folly of omitting depreciation, could you elaborate on your thoughts on other pitfalls of alternative financial presentations? Is EBITDA, in your view, just too often used as a shorthand for cash flow, or is the entire concept of recasting accounting data a suspect exercise? And which revisions might be appropriate, if any, and what might be viewed as red flags? And does it matter to you who is making those adjustments, analysts, investors for their own purposes, or company managements in terms of how that information should be viewed?
Yeah, we regularly told you for some years before the accounting change was made here a year or so ago, we told you should not count goodwill amortization. It was required under GAAP, and we obviously complied with GAAP, but we told you every year virtually that I can remember, we said this is not really an economic expense, and we ignore it in our own calculations of earnings in terms of what we will pay for businesses. We don't care whether there's a goodwill item or not, because it's immaterial to economic reality. So we have been quite willing at Berkshire to tell our own owners to ignore certain things, and if they disagreed with us, they could look at the GAAP figures, but we felt they were getting misled by looking at the amortization of intangibles. That doesn't mean we think all intangibles were good, but we did feel that was an arbitrary and a decision that didn't make any sense at all. And we felt, obviously, as we talked about, we felt that crazy pension assumptions have caused people to record phantom earnings in many cases. So we're willing to tell you when we think there is data that is more important in economic analysis than GAAP figures. we'll talk to you about it. Not thinking of depreciation as an expense, though, strikes us as absolutely crazy. I can think of very few businesses. I can think of a couple, but I can think of very few businesses where depreciation is not a real expense. Even at our gas pipelines, I mean, you know, at some point they'll need repairs, but beyond at some point they become obsolete. I mean, there won't be gas there 200 years from now. We know that. So depreciation is real, and it's the worst kind of expense. It's reverse float. You know, you lay out the money before you get revenue, and you are out cash with nothing coming in. And depreciation, any management that doesn't regard depreciation as expense is living in a dream world. But of course, they're encouraged to do that, by investment bankers who talk to them about EBITDA, and then certain people have built fortunes on misleading investors by convincing them that EBITDA was a big deal. And when we see companies that say, hey, we don't pay any taxes, and because we don't have any earnings for tax purposes and don't count depreciation and all of that, that's coming, in our view, many times that's coming very close to a flim-flam game. I get these people that show me, they want to send me books with EBITDA in it, and I just tell them, I'll look at that figure when you tell me you'll make all the capital expenditures. If I'm going to make the capital expenditures, there's very few businesses where I think I can spend a whole lot less than depreciation year after year and maintain the economic strength of the business. So I think the EBITDA has been a term that has cost a lot of investors a lot of money. You saw it in the telecom field. I mean, the idea that they were spending money so damn fast, they couldn't have it coming in the door fast enough from investors. And then they pretended that depreciation was not a real expense. That's nonsense. I mean, it couldn't be worse. And a generation of investors were sort of brought up to believe in that. We at Berkshire will spend more than our depreciation this year. We spent more than our depreciation last year. We spent more than our depreciation the year before that. Depreciation is a real expense. Just as much as, expenditure for life. It's not a non-cash expense. It's a cash expense. You just spend it first. The cash is gone. And it's a delayed recording of cash. How anybody can turn that into something they use as a metric that talks about earnings is beyond me. Charlie?
Yeah, I think you would understand any presentation using the word EBITDA. If every time you saw that word, you just substituted the phrase bullshit earnings.
I knew he'd do it sooner or later, folks. And he made it through the morning, but never all day.
First question, in your letters to shareholders, you said you believe EBITDA is not a good parameter to value a business. Why is that? Can you elaborate on that?
In respect to EBITDA, depreciation is an expense, and it's the worst kind of an expense. We love to talk about float, and float is where we get the money first and we have the expense later. Depreciation is where you spend the money first, and then record the expense later. And it's reverse float, and it's not a good thing. And to have that enter into a multiple, it's much better to buy a business that has, everything else being equal, has no depreciation because it has essentially no investment in fixed assets and makes X, than it is to buy a company that where there's a lot of depreciation in getting to X. And actually, I may write a little bit more on that next year, just because it's such a mass delusion, and of course it's in the interest of Wall Street enormously to focus on something called EBITDA, because it results in higher borrowing power, higher valuations, and all of that sort of thing. So it's become very popular in the last 20 years, but it's a very misleading statistic, can be used in very pernicious ways. Charlie, on either one of those subjects?
I think you've understated the horrors of the subject and the disgusting nature of the people that brought that term into the valuation of business. It was just, it would be like a leasing broker of real estate you had 1,000 square foot suite to be leased, and he says it's got 2,000 feet in it. That's not honorable behavior, and that's the way that term got into common usage. Nobody in his right mind would think that depreciation is not an expense.
Yeah, but it's very much in the interest of Wall Street.
Yes, that's why they did it.
Yeah.
It made the multiple seem lower.
And what's amazing is the way it's accepted, actually. But anyway, it just illustrates how people use language, and sell concepts that work to their own use, and 2 and 20 has the same sort of thing. I mean, the number of people, the amount of money that's overperformed after paying 2 and 20 compared to the expenses that have been incurred, I will assure you, makes for a terrible indictment of that particular arrangement. But as long as it can get sold, it will get sold.
And now they use it in the business schools. Now that is horror squared. I mean, it's bad enough that a bunch of thieves start using a term, but when it gets so common, the business schools copy it. That's not a good result.
Most American corporations separate out supposedly one-time restructuring costs, whereas Berkshire doesn't. Berkshire's reported operating earnings are therefore, in my opinion, of higher quality. Have you ever calculated how much higher operating earnings on average would be if Berkshire separated out plant closing costs, product line exits, severance pay, and similar items? Is it a material number, or does Berkshire not incur much in the way of these types of costs typically because most of your acquisitions are standalone?
Let me take that one. That's a question like asking, why don't you kill your mother to get the insurance money? We don't do it. We're not interested in manipulating those numbers, and we haven't had a restructuring charge ever, and I don't think we're about to start.
Yeah. I would say this too, Johnny. We don't do that. The numbers would not be huge. You know, there could be a year, I suppose, when they might be for some reason, but they are more conservatively stated than most companies, and I think they're of higher quality. And but I pointed out also that I think that our depreciation expense at the railroad, which is standard and which all the other railroads use, is inadequate as a measure of true operating earnings. But that's...
And you're talking about, we like to advertise our defects.
Not all of them. There's no question that I think we will have more amortization of certain intangibles which reduce earnings and reported earnings, but which in reality are not expenses. We'll have more of that than some companies, and I pointed that out. I never want to report one of these things where I have the whole adjusted earnings set out and say this is what you're supposed to pay attention to, because every one of those I've seen virtually results in some inflation of figures. Things are good enough with Berkshire. We don't need to inflate the figures.
Also, would like your thoughts about some businesses today with their huge inventory write-offs. What your thoughts about those are?
Second question about inventory write-offs. That gets into the category entirely of big bath charges, which are the tendencies of management. When some bad news is coming along, to try and put all the bad news that's happened into a single quarter or a single year, and even to put the bad news that they are worried about happening in the future into that year. And it leads to real deception in accounting. The SEC has tried to get quite tough on that, but my experience has been that managements that want to do it usually can find some ways to do it, and managements frequently are more conscious of what numbers they want to report than they are of what has actually transpired in a given quarter or a given year.
Warren, in the past, you've enjoyed discussing accounting for options grants. So I'm curious, what's your view of the new accounting standard which mandates that companies report lower tax provisions based on so-called excess tax benefits enjoyed when share-based compensation ends up being more profitable for the grantees than when it's initially modeled? These so-called benefits, excess benefits, used to go through the shareholders' equity line on the balance sheet. Which accounting method makes more sense to you, the old method or the new?
Johnny, I think you know a lot more about it than I do. So if I were asked to answer that question, I'd probably call you up and say, what should I say? It's not a factor that will enter into Berkshire, so I really have not. I mean, I've heard just a little bit about that accounting standard, but I really don't know anything about it. Charlie?
It's not a big deal, Warren.
Yeah, well, I know that. Yeah. There are a few things in accounting we really disagree with, and whether they might be material to somebody trying to evaluate Berkshire, and that primarily gets into amortization of intangibles. It certainly gets into realized capital gains and that sort of thing, and we will go to great lengths to try to tell our partners, basically, not all of whom are accounting experts or anything, and we will try to make clear to them at least what our view is, the same way as if I had a family business and I was talking to my sisters or something about it. But unless it's material, we'll probably stay away from trying to opine on any new accounting standards. If it's material to Berkshire, we'll go to great lengths to at least give our view. Charlie?
Well, I certainly agree with that.
Okay.
That what he's talking about is not very material to Berkshire.
No, it isn't, and it really won't be. Some of these others are those, and we will bring those up as they come up. We are reporting $400 and some million less in our earnings than if Precision Cast Parts had remained a public company. Well, is Precision Cast Parts, I mean, are the earnings less real? Is the cash less real? Is anything? Because it's moved the ownership? I don't think so. And I want to convey that belief to shareholders, and they can debate whether it's right or wrong. But I think it's a mistake not to comment and just assume that the owners understand that, because it's a fairly arcane point, and so we pointed out. But we also pointed out, if we think depreciation is inadequate as for valuation purposes, the depreciation is inadequate at a very capital intensive business like BNSF, which we, I must say, still love. Anyway, starting, I don't even want to tell you about this one, but starting the first of next year, accounting is going to become sort of a nightmare in terms of Berkshire and other companies, because they're going to have us mark our equities to market, just like we were a Wall Street trading firm or something, and those changes in the value of Coca-Cola or American Express or anything are going to run through the income account every quarter. In fact, they run through it every day in this series, so that it really will get confusing. Now, it's our job to explain things so that you aren't confused when we report GAAP earnings. But GAAP earnings, as reported, will become even more meaningless looking only at the bottom line than they are now. And
that was not necessarily a good idea.
No, I think it's a terrible idea, but we'll deal with it. I mean, it's my job to explain to what extent GAAP accounting is useful to you in evaluating Berkshire, and the times when it actually distorts things. Accounting isn't supposed to it's not supposed to describe value. On the other hand, it's a terribly useful tool, if understood, in order to estimate value if you're analyzing businesses. And so, in a certain way, you can't blame the auditing profession for doing what they think is their job, which is not to present value, although by using these market values.
But you can blame the audit profession.
What's that?
You can blame the audit profession for that one.
Well,
that was really stupid.
I agree with that, actually. But we will do our best to give you, we're always going to give you the audited figures, and then we're going to explain their shortcomings in either direction and what you should use and what you probably should ignore in looking at those numbers and using them to come to a judgment as to the value of your holdings. And I'll explain it to you the same way I would explain it to my sisters or anybody else. That we want you to understand what you own, and we try to cover the details that are really important in that respect. There's a million things you can talk about that are just of minor importance when you're talking about a $400 billion market value. But they're the things that if Charlie and I were talking about the company, they'd be the figures or the interpretations or anything that we would regard as important in sort of coming to an estimate of the value of the business. But it's going to be, you can't knock the media. I mean, they've only got a few paragraphs to describe the earnings of Berkshire every quarter. But if they simply look at bottom line numbers, what can be silly this year will become absolutely ludicrous next year because of the new rule that comes into effect for 2018. This morning, we posted both our earnings and our 10Q, and if we can put up slide 1, you can take a look at what was reported. And as I warned you in the annual report, a new accounting rule was introduced at the beginning of this year, and it provides that our equity securities, whether we sell them or not, are marked to market every day. So we can have a gain or loss of a couple $2 billion in our equity securities portfolio, and that day, according to the accounting principles now in effect, which are to change, will be recorded as making a couple $1 billion that day or losing a couple billion. And I told you that would produce some very unusual effects from quarter to quarter. And it further explains why I like to release our earnings early Saturday morning, and as well as the 10Q, to give people a chance to read through the explanation. Because if you just were handed this with a TV monitor, at 3:30 in the afternoon or whatever it might be, you would report the net earnings figure understandably very quickly, and it really is not representative of what's going on in the business at all. So if you look at the figure of operating earnings, which is what we look at, we actually earned a record amount for any quarter we've ever had, and that includes no realized gains or losses on securities or on the few remaining derivatives we have. You might leave that slide up there just a little longer, maybe there's some. The insurance underwriting, GEICO had quite a good sized turnaround in profitability and a good gain, although not as big a gain as last year, which was a record in terms of policies in force. And really throughout most of our businesses, and the details are on the 10Q, which is up on our website now. And as you can see, the railroad was up significantly, and we had most of our businesses tended to be up. Now, we were aided in that in a material way by the reduction in the federal income tax rate from 35% to 21%. Our businesses were up significantly on a pre-tax basis, but the gain was further enhanced by the change in the income tax rate. Now, this morning we posted on our website the quarterly, the 10Q that's required to be filed with the SEC. We published it at 7 o'clock Central Time.
And we also published an accompanying press release. And these figures, as usual, require some explanation. As we've mentioned in the annual report, the new GAAP rules, generally accepted accounting principles, require that we mark our securities to market and then report any unrealized gains in our earnings. And you can see, I've warned you about the distortions from this sort of thing. And the first quarter of 2019 actually was much like the first quarter of 2018. And I hope very much that newspapers do not read headlines saying that we made $21.6 billion in the first quarter of this year against the loss of last year. The bottom line figures are going to be totally capricious. And what I worry about is that not everybody studied accounting in school, or they can be very smart people, but that doesn't mean that they've spent any real time on accounting. And I really regard these bottom line figures, particularly if they're emphasized in the press, as potentially being harmful to our shareholders and really not being helpful. So I encourage you now, and I encourage all the press that's here, focus on what we call our operating earnings, which were up a bit, and forget about the capital gains or losses in any given period. Now, they're enormously important over time. We've had substantial capital gains in the future. We have substantial unrealized capital gains at the present time. We expect to have more capital gains in the future. They are an important part of Berkshire, but they have absolutely no predictive value or analytical value on a quarterly basis or an annual basis. And I just hope that nobody gets misled in some quarter when stocks are down and people that Berkshire loses money or something of the sort. It's really a shame that the rules got changed in that way, but we will report, but we will also explain, and we will do our best to have the press understand the importance of focusing on operating earnings, and that we do not attract shareholders who think that there's some enormous gain because in the first quarter the stock market was up. Now, if that's your assumption, and you're already capitalizing those profits at a pretty good multiple, then you have to say that you have to come to the conclusion that the value of American business will grow at a relationship that's not much greater than the growth in GDP. And most of you would estimate that probably to be, maybe 5% a year. If you expect a couple percent a year of inflation. So I wouldn't change my thoughts about the profitability of American business over time, and I wouldn't change my thoughts much about the relationship of stock prices over time to those profits. So I would come down very similarly. Now, interestingly enough, some of those same relationships prevailed decades ago, but you were buying stocks that were yielding you perhaps 5% or something like that, so that you were getting 5% in your pocket plus that growth as you went along. And of course now if you buy stocks you get 1.5% if you're the American public before the frictional costs, so that the same rate of growth produces a way smaller aggregate return. So I think stocks are a perfectly decent way to make 6 or 7% a year over the next 15 or 20 years. But I think anybody that expects to make 15% per year, or expects their broker or investment advisor to make that kind of money, is living in a dream world. And it's particularly interesting to me that back when the prospects for stocks were far better, I even wrote something about this in the late 70s, pension funds were using investment rate assumptions that were often in the 6% or thereabout range. And now when the prospects are way poor, most pension funds are using
building into their calculations returns of 9% or better on investments. I don't know how they're going to get 9% or better on investments, but I also know that they changed the investment assumption down and they changed the charge to earnings substantially, and they don't want to do that. So they continue to use investment assumptions, which I think are quite unrealistic, and with companies with a big pension component in their financial situation and therefore in their income statement, that can be quite significant. It'll be interesting to me to see whether in the next couple of years, where pension funds are experiencing significant shortfalls from their assumptions, how quickly they change the assumptions. And the consulting firms are not pushing them to do that at all. It's very interesting. The consulting firms are telling them what they want to hear, which is hardly news to any of us, but it's what's taking place.
Yeah, pension fund accounting is drifting into scandal by making these unreasonable investment assumptions. It's evidently it's just part of the human condition that people extrapolate the recent past, and so since returns from common stocks have been high for quite a long period, they extrapolate that they continue to be very high into the future. And that creates a lot of reported earnings in terms of pension benefits that aren't available in cash and are likely not to be available at all. And this is not a good idea, and it's interesting how few corporate managements have just responded like Sam Goldman, include me out. You'd think more people would just say, this is a scummy way to keep the books. I will not participate. Instead, everybody just drifts along with the tide, assisted by all these wonderful consultants.
I don't know of any case in the United States right now, and I'm sure there are some, but except for the pension funds that we take over, I don't know of any case where people are reducing their assumed investment return. Now, you think if interest rates drifted down several percentage points, that might affect what you would think would be earned with money. It certainly is to bondholders or to us with float or something of the sort. But most major corporations, I believe, are using an investment return assumption of 9% or higher. And that's with long-term governments below 6%, maybe high-grade corporates at 7%. They don't know how to get it in the bond market. They don't know how to get it in the mortgage market. I don't think they know how to get it in the stock market. But it would cause their earnings to go down if they change their investment assumption. And like I say, I don't know of a major company that's thinking about it. I don't know of a major actuarial consultant that's suggesting it to the managements. They'd rather not think about it.
The way they're doing things would be like living right on an earthquake fault that was building up stress every year and projecting that the longer it's been without an earthquake, the less likely an earthquake is to occur. That is a dumb way to write earthquake insurance. And the current practice is a dumb way to do pension fund planning and accounting. Dumb and improper.
Talk to a management or board of directors about that, you get absolutely no place.
Your eyes would glaze over before the hostility came. And the man asked the question also, says, what remaining big accounting troubles exist? The real Lollapalooza is pension fund accounting and to some extent post-retirement medical liabilities. Those are horribly understated now in America, and they're very big numbers.
I've looked at financial statements, and you've seen them too in the last few months, where companies are recording pension income in the hundreds of millions while at the same time being underfunded in their pension plan in the many billions. And they just aren't facing up to reality at all, and they don't want to because they don't want to take the hit. And they're just, it's the same mentality as stock option expenses. And they are paying people with stock options, but we pay people with cash bonuses. And I suppose, we might, it isn't really true, but we might like it if we didn't have to record cash bonuses as an expense. I mean, it's the way we pay people. And you can say, well, why don't you put it in the footnotes and leave it out of the income account like they do with option expenses, which is a form of compensation too. But the answer is that a bunch of people who cared very much about having their stocks float to unreasonable prices, at least in our view, found they could do it a lot easier if they didn't count compensation expenses. And why not put all expenses in footnotes? Just have an item there that says sales, and then have the same figure for net profit, and then just have all the expenses in the footnotes. And people with a straight face, say, well, it's in the footnotes, so therefore everybody knows about it, and we don't have to count it, put it in the income account. It's amazing what people with high IQs will do to rationalize their own pocketbooks. And Charlie has another explanation for why there's been this denial of the reality of option expense in terms of people's ego getting involved with their own records. So many names.
No, I'm so tiresome on this subject, and I've been on it for so many decades. It's such a rotten way to run a civilization, to make the basic accounting wrong. It is very much like making the engineering wrong when you're building a bridge. And when I see reputable people making these perfectly ridiculous arguments to the effect that it's unthinkable that options be expense. Well, because it's too difficult to value, or God knows what reason. And a lot of them are people you'd be glad to have marry your daughter. And
yeah, because they're rich, for one thing.
Yet the truth of the matter is they're somewhere between crazy and crooked.
Put him down as undecided.
Question has to do with how the FASB has caved in on the stock option proposal, and the people opposed to the proposal argue that it would hurt capital formation for companies, and that the cost of stock options is already reflected in shares outstanding in fully diluted calculations. And I was curious, what is your feelings about what's happened?
Well, as those of you who followed this issue, the FASB did cave in it. They hated it. I mean, they knew they were right. As a matter of fact, most of what are now, I guess, the big six auditing firms are big. Many years ago, sided with the position, but in my opinion, the auditing firms caved to their clients in that respect. And in terms of capital formation, I would argue that the most intelligent form of capital formation follows from the most accurate form of accounting. I mean, that if all the companies whose names began with A through M didn't have to count depreciation, and all the ones with M through Z did or something, that might help in capital formation for companies that had names with A through M, and incidentally they probably all changed their names. But I don't think that bad accounting is an aid to capital formation. In fact, I think probably over time it distorts capital formation, because if we were to pay all of the shareholders all of the people who work for Berkshire Hathaway in stock, and therefore record no wage expense, we might be able to sucker in a bunch of people who thought the earnings were real, but that would not be a great step forward for capital formation, in my view. I really think that, I've talked privately to a number of managers about this, and they understand it, but they prefer the present situation, and they used a lot of muscle in Washington. Many years ago, and I think I have this authenticated now. This fellow mathematics professor sent me some material after I'd written this. I try to get a little proof after the fact when I can. I believe it was in the Indiana legislature, where a legislator introduced a bill to change the value of pi, the mathematical symbol pi, to 3, because he said that it was too difficult for the school children to work with this complicated 3.14159. And he was right. I mean, it was difficult. And Congress, in connection with the stock option question, received all kinds of pressure to in turn pressure FASB and the SEC to not count stock option costs as part of compensation. I've never met anybody that wanted to be compensated that felt that if he received his present salary plus an option, he was not getting compensated more than if he just received the salary. So he thought it was compensation. And I will tell you that if we'd been issuing options over a period of time at Berkshire for things unrelated to the performance of the entire business, that we would have had a cost, perhaps measuring in the billions of dollars, whether it was recorded or not. So it goes back to Bishop Berkeley's question of whether a tree that falls in the forest and doesn't make a sound, et cetera. But I think it is. I really think it makes you a bit of a cynic about American business when you see the extent to which a group has pressured, even to the extent of talking about withdrawing financial support from the Financial Accounting Standards Board, to the degree to which they've pressured people to make sure the value of pi stays at 3 instead of 3.14, simply because it was their own ox that was being ordered. In any event, it looks like it's all over now for some time. In fact, now they're pressuring to even weaken further the standards that have been set. So self-interest is alive and well in corporate America. Charlie?
Yeah, I think dishonor won, and I think that I think it is quite important for a civilization to have sound engineering and good accounting, and it is a very regrettable episode. Leading politicians, leading venture capitalists. I think to some extent it's an indictment of the educational system that this thing could be so widely looked at and so wrongly.
It's bad enough people want to cheat on their accounting, and they do cheat on their accounting, but to want it to be endorsed as the system is really kind of disgusting.
Yeah, corruption won.
My first question is on the quality of earnings and your evaluation of quality of earnings in the U.S. right now.
As to quality of earnings, Charlie and I feel that in several respects, but in one important respect, that the quality of earnings has gone down, not because the policy has changed, but because it's just become more significant, and that's in the case of stock options. There are certain companies that we've evaluated for possible purchase where in our calculation of earnings, the earnings are maybe 10% less per year, per share, than reported. And that isn't necessarily the end of the world, but it is a difference in valuation that is significant and is not reported under standard accounting. So we think the quality of earnings as reported by a company with significant stock option grants every year, we think is dramatically poorer than one where that doesn't exist. And there are a lot of companies that fall in that category. Coca-Cola's earnings are very easy to figure out. Just figure out what they're earning per case from operations, and you'll see over the years the earnings per case go up, and the cases go up and the shares go down. And it doesn't get much more complicated than that. Charlie?
You've said it wonderfully.